Good morning, friends. This is revision video of Ind AS 10 events occurring after balance sheet date. So the objective of the standard is to guide the company on how to treat the events which has happened after the reporting period. So the scope covered by this standard are two. One is accounting of events which has happened after the reporting period. Another one is disclosure of such events. So what are events occur after reporting period? So it means whatever events which has occurred after the balance sheet date and before the approval of financial statements. So basically, if for example, if the company follows a year in April to March, in that case, events after occurring after 31st March and before FS is authorized by the management. So FS authorized by the management is the cutoff date which we have to take. So what kind of events we should take is the next question. So the events might be favorable or unfavorable. Uh, Even after public announcement of results by way of interim financial statements, uh, if there are any change which is required by the standard can be adjusted for. Then approving authority. So the standard says events occurring after balance sheet date but before approval of FS. So who is the approving authority is the next question. So approving authority in case of company might be board of directors and in other cases corresponding authority. We have to keep it in mind that the first level of management should be taken. So in case of company, board of directors should be taken, not the shareholders. So in case of others, it is corresponding authority. For example, if Ind AS becomes applicable to a partnership firm in the near future, then in this case, managing partner in a partnership firm. So there are two types of events. One is adjusting event, another one is non-adjusting event. So as the name goes, adjusting events are events there was for which there was a condition which was existing before the balance sheet date, and that presence of condition ha- uh, has been proved by the event which has happened after the balance sheet date. And non-adjusting events are those events for which both condition and event has occurred after balance sheet date. So for adjusting event, we have to adjust the financial statements, and for non-adjusting events, we have to just disclose the information which is required by the standard in some cases alone. So in Ind AS 10 has given 5 cases in case of adjusting event. Apart from these, there might be any cases also, but Ind AS has given some 5 specific cases in the standard itself. First is court case. Second one is about credit impairment of the asset. Third one is about sale price and purchase price of the asset. Fourth one is about profit sharing and bonus payment. Fifth one is about fraud and error. So in the first case, what the stand is telling is, for example, as on 31st March, there was a court case which was going on with the company, and for which verdict is not yet known to the company. But after 31st March and before the approval of financial statements, we have come to know about the result of the case, whether we have won the case or whether we have lost the case. So in that case, the provision which was created before the approval of financial statement can be adjusted for if it is requiring. So the second case is where if the information, if we have received any information about the impairment of any asset after the balance sheet date but before the approval of FS, then in that case we can adjust for impairment. For example, there was a debtor whom has for whom there was a heavy loss as on 31st March but after the balance sheet date but before approval of FS, he has gone bankrupt. So in the first case, as on 31st March, we would have created a provision for bad and doubtful debts, but since he has become bankrupt after the balance sheet date, it means that the provision has converted into full bad debt itself. So in that case, instead of creating a provision, we can adjust for we can write off the entire amount as bad debt itself. And in the second case, if there is a fall down in the price of inventory, which is less than cost, then if it is less than cost, let's take for example, cost of the asset is, as on 31/3, cost of the asset is 10 rupees and NRV of the asset is 12 rupees. In that case, we would have measured at 10 rupees, so no problem. But as on 31 May, the cost of the asset is 10 rupee and the NRV of the asset is 11 rupee. In this case also there is no problem because the NRV has fallen down to the extent of only 1 rupees. Even then we'll be measuring at 10 rupees only. However, if the NRV of the asset has become 9 rupees, then in that case, as on 31st March, the asset is valued at price which is more than what it is sold, and it is not correct. So in that case, we will adjust this 10 rupees to 9 rupees and we'll write down at NRV. Third example, which is given by the standard, is for example, if we are entering an agreement for sale or purchase of asset and everything is done as on 31/3 itself, but sale price and purchase price is known accurately only after 31st March, then in that case, the amount as after the 31st March, that is sale price and purchase price, can be taken as on 31st March. And the fourth case is, for example, the entity has given a bonus plan to its employees, telling that it will pay bonus based on the profit for the year ended 31/3/2022. However, the so whatever the profit which you have calculated on 31/3/2022, uh, on that some percentage they are paying. So the amount of profit will be known only on 31/3 to 2022. So even though they are paying it after 31/3/22, since it is for the year 31/3/22, we can adjust for those events. And let's take for example the fifth case is for discovery of fraud or error. If in the first, let's take one example. As on 31/3/2022, there was a fraud happened which was not known to the management. However, the fraud is found out after the audit and all, after the balance sheet date, but before approval of FS. So in that case, since the fraud has happened before 31/3 itself, we can adjust for the fraud and errors. So these are the 5 cases which is explained by the standard. And next is, what is the treatment of non-adjusting event? Non-adjusting event does not have to be adjusted in the balance sheet. However, if it is material, then two things has to be disclosed as per the standard. One is the nature of the event, another one is the amount. So amount, what is the estimate and what is the effect of, because of such events that might happen in the balance sheet. So for example, examples are mergers, buyback, fire and earthquake, share issue, major asset purchase. All those are examples given in the standard. And there are some special cases which is dealt by the standard. One is long-term loan arrangement and another one is going concern. So what is long-term in the standard? What the standard telling is, for example, mm, as on before 31, that is before balance sheet date, before the end of the balance sheet date, there was a the company has breached a material provision in the balance sheet. So in the loan agreement, what they have said is, if you breach the provisions which is given in the loan agreement, then the liability will be payable on demand. So, and the company has already breached also, and because of its breach, the loan has payable on demand, the loan has become payable on demand, so that it has become current liability. Before the loan was a non-current liability, but now due to its breach, the provision has come to current liability. But after the balance sheet date, but before approval of FS, they have entered into a new loan agreement. So that new loan agreement, because of that new loan agreement, the bank is telling that okay, we'll not demand loan amount now itself. And again, so the current liability is not a current liability now, it is a non-current liability. So even though everything is happening after the balance sheet date, the standard is telling that even though it is a current liability, because of this new agreement, since it has become again a non-current liability, that non-current liability can be adjusted for. That is, let the non-current liability remain a non-current liability itself. Uh, Finally, whatever it was in the balance sheet, that is, if it was a non-current liability, it will remain as a non-current liability. Basically, non-current liability, a bank is demanding loan because the company has become because the company has breached a provision in the balance sheet, so it has become a current liability. Again, because the company is entering into a new agreement, the loan has become a non-current liability. So the standard is telling it's okay. So you can adjust this current liability into a non-current liability itself. Going concern is a base wherein the company is not going to liquidate in the near future. However, if the going concern concept of the company is affected, then in that case, the company should not prepare it FS on a going concern basis if it is going to liquidate the entity, or if it is going to cease its operations, or it will not be able to do anything in the near future for the recovery of itself, then the company should not prepare the balance sheet on going concern basis. So, what are the indicators? Deterioration or in the financial and operating result are the main indicators of going concern. So, if the going concern is not appropriate, then and the effect is that the company is going to liquidate in the near future, then we have to change the entire basis of accounting itself, which will be described in Ind AS 1 already, and it is an adjusting event. So if the going concern, we are finding that the company is no longer is a going concern entity, that which is because of some events which has happened after the balance sheet date. In that case also we can adjust the balance sheet. So, if the then the disclosures for going concern as per Ind AS 1 is FS are not prepared as per going concern, and the management awareness of management about the material uncertainties. So, if the entity is going into liquidation, how will the balance sheet be prepared is entire carrying amount of assets and liabilities would be changed, and the long-term liabilities would be converted into short-term liability, obviously, because since we are going to liquidate the entity, we have to pay off the entire liabilities by diluting our assets. So, dividend. If the dividend to equity shareholders, main concept is equity shareholders, not the equity which is classified as per Ind AS 32, or declared after the reporting period but before the approval of standard, then it is a non-adjusting event. So this is basically proposed dividend. So if the proposed dividend is declared after the reporting period also, and before the approval of FS, but even then, if the dividend is relating to previous year, in that case also it is a non-adjusting event, but it has to be disclosed as per Ind AS 1. Then one of the special cases which is described in the appendix to Ind AS 10 is distribution of non-cash assets to owners. So if we are distributing any other than cash, if we are distributing any other assets to the equity shareholders of the entity, how will we measure? So we will create a liability for dividend payable, and the how will the so what is the amount on which dividend payable to be measured is, it has to be measured at fair value of asset distributed. So when it has to be measured is as on the date of approval for such distribution. If there is a choice given, for example, the owner is given both cash option and non-cash option, then in that case it should be measured based on the probability of each option. So how will we remeasure the dividend payable which was recognized is as at the end of reporting period, we should adjust the carrying amount of the liability, and the difference should be adjusted in equity itself. On settlement, we should take the carrying amount of the asset and the dividend payable, and the difference should be recognized as profit and loss in the P&L. So let's take one example. There was an entity which decided to distribute calculator to 10 shareholders, and the fair value of the calculator is 100. Then approval date is 31/3/2020. So settlement date is 31/3/2022. So in that case, for as on approval date, dividend payable has to be created at fair value of the calculator, that is 10 into 100. Then if supposing the same example, if there is an option given to the um, owners, then in that case it should be measured based on the probability. The dividend payable should be measured based on the probability. So in this case, this is the extended scenario of this case. So if the fair value of the calculator becomes 90 rupees as on 2021, that is uh, the year before, on the year before which settlement is happening, this year before 2022, in that case the fair value should be adjusted, in P&L. On settlement date, if the fair value of the calculator is becoming again 120, again the dividend payable has to be adjusted. So in this case, it has become 90. So the dividend payable has to be reduced by 10 rupees in this case, and the difference should be adjusted in P&L. So again, this 90 rupees we have to convert into 120. So the difference of 30 rupees, again it has to be adjusted in P&L. And next settlement, when we pass settlement entry, so dividend payable will be measured at 120. However, the carrying value of the calculator as on the date is 40, that has to be de-recognized, and the balance gain or loss should be measured in P&L. Thank you guys. We'll be seeing sums in the next video. Thank you.